All right, Steve, you're going to stick around for just a minute, and we're going to dive a little bit deeper into the data and the real story on spending, growth, and more. Here with me, Stanley, Chief U.S. Economist at Santander, and Barry Knapp, Director of Research at Ironsides Macroeconomics. Barry, it's good to have you in the house and not from your house out in the mountains, but it's nice to be in the mountains as well. Stephen, let me start with you. If I were to sum up how I read my notes from you, it is this. Growth is growing, inflation is slowing, but the slowing may be slowing in inflation.
Yes, you got it exactly right.
I got it.
I don't know if anyone else could follow that, but yes.
All right, I got it. So you like the growth profile that you're seeing?
Yes.
And even more than you did yesterday.
A little bit, yeah, because the September data was stronger than expected. So Steve suggested that leaves you with a little bit more momentum coming into the fourth quarter. So I think we could see something close to 2% growth again in the fourth quarter, which is obviously not 5%, but it's still pretty healthy.
And there's the 2.3% prediction from the Atlanta Fed, so that's kind of in line with that. Barry, you're have a slightly more cautious take, and I think if I were to bear down, you see some concerns in commercial real estate, right? Correct, among other areas that you see as potentially, quote, systemic risks.
Yeah, more broadly, I've been characterizing the situation in the U.S. economy as an unstable equilibrium. So we know the dynamic around the household sector, which is largely termed out its debt, the effective mortgage rate of 3.6%. So in aggregate, households are in reasonable shape. Large non-financial corporate sector is similarly positioned, again, long duration debt. But the deep inversion of the yield curve, which the only precedents are 73, 79, and 80, created a very unstable situation in the small banking sector. You could look at the performance of bank stocks after last week's earnings results for some further evidence of that, which is going to translate into a real problem in multifamily real estate. I'm less concerned about office space, but multifamily real estate, we have a million units.
Apartment buildings, townhouses.
Correct. We have a million units under construction that were initially, financed by construction loans. Those will need to be refinanced into multifamily loans with the base rate up 500 basis points or 5%, and rental growth having slowed from 15% down to 0. There's also obviously a big problem with the banking system financing government, the federal government, as evidenced by the big move in longer-term rates over the last couple of months, and small businesses in general that finance themselves through floating rate loans, again, through the small banking sector. So that's the piece that's unstable, and strong data is just exacerbating that by pushing out the point when the Fed will start to reverse some of the
Stephen, you want to
tightening.
react?
No, I think there's definitely, this is all part of the process of the Fed trying to get financial conditions tighter. And there are going to be winners and losers in that process. So it shouldn't be surprising that we're seeing some cracks in the system. And in fact, you think about the fact that economists have been calling for a recession since the beginning of the year, and we haven't seen it yet. So I think the economy eventually will slow, but so far it's proven certainly more resilient.